It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. I've got some interesting economic information and feelings about the American public. Those of you who've listened to the show, you know I discuss financial issues with clients literally from coast to coast. I have the advantage of speaking to people from literally coast to coast, which is very unusual in the financial industry. Most financial advisors focus on a certain region or area. Being on the radio has a tremendous blessing and allows me to talk to folks from all walks of life, all regions of the country. So I think I have a better feel than certainly most do in terms of what the economy is doing, how it's affecting everyday Americans, the average folks. Yes, I have very wealthy clients, and I have folks that don't have a whole lot or just getting started or just starting over, and everything in between. It gives me a very interesting perspective that I enjoy sharing on this show, and I think this is why so many people like to listen. But there's a couple articles that really echo what I've been seeing and feeling and hearing from people as I talk to them. A recent study came out and stated that nearly 40% of American adults say they are concerned about keeping up with their bills, according to a new CNN poll. As one of the respondents stated, the grocery store is just outrageous now. And it's not just that, everything is gone up. Clothing, my insurance, everything. Also, the CNN study found that Americans are now holding a record amount of household debt. And as another respondent stated, the pressure is real. Everything is so much more expensive than it was 4 years ago. It's astronomical what you're paying. I've had to cut back on the fun things I like to do. To put things in perspective, the report revealed that only 37% of American adults were concerned about paying their bills during the 2008 Great Recession. And I like this point they made in here is we can all discuss how inflation is moderating, but the cumulative impact of several years worth of inflation has done quite a number on household budgets. And that's just a fact. It's really impacting many, many people. One of the financial experts in the report even stated that the national economic reporting indicating that the economy is still growing, quote unquote, is a statement that does not fully explain the impact of inflation on families. And I liked what he stated here. This is really, I think, nails the point down. He stated, the view from 35,000 feet is that unemployment is low, the economy is growing, and people are spending money. But the reality on the ground is moderating inflation does not mean prices are coming down. It's just not that they're not going up as fast as they were. And he's so right. I discuss this on the show so often is, yes, the rate of inflation may be increasing at a slower rate, but it's the cumulative effect of multiple years of inflation that really does the damage to households' buying power. And if you think about it, even if your income had increased significantly over the last 3 or 4 years, well, prices have too, which means you're just treading water. And unfortunately, most people have not had their incomes increase at the rates we've seen of inflation increases in the last 3 to 4 years. The report also stated that because of grocery bills making life so difficult, more than a quarter of Americans are now resorting to skipping meals in order to avoid paying the inflated grocery store prices. And folks, I don't know about you, but that's just really sad that a quarter of Americans in the richest country in history, with all the wealth that we have, the opportunities, everything that's happened, 1 out of 4 people are actually skipping meals because they cannot afford the grocery store. That is not the country that I know, and that's not the country that we should be living in. Things need to change. And another article even points out here, by most measures, as they state, the U.S. economy is doing well, yet many people would argue otherwise. In fact, Another study shows that roughly 3 in 5 Americans believe the U.S. is currently in a recession. And in fact, most of the respondents believe that the recession started approximately 15 months ago. And that's why we have a low point in the confidence in terms of the U.S. economy. I understand we keep seeing numbers, like they state, that look good, but those are, again, a 35,000-foot view, not what's really going on the ground. In fact, I really like this statement that Joyce Chang, JP Morgan's chair of global research, stated when she said that we're in a vibe session. And what she meant by that, I think, is really accurate. If you're a homeowner or if you own significant financial assets, you've done very well. We've seen historic gains in housing and the stock market. But the problem is the wealth creation was concentrated amongst homeowners in upper income brackets, which means a good 1/3 of the population or so has been left out. And that is why we're seeing such a disconnect. I think she's nailed it on the head right there. Again, like she said, there's no question that housing prices and stock market values in the past decade have grown exponentially. And folks that own those assets have done very, very well. But that is not the majority of Americans. And a lot of people have fallen behind as a result. And there's a growing sense of frustration. And this affects a lot of things, from the economy, of course, politically. Maybe it starts, if you're not in that boat, maybe you start to understand why so many people who are feel disenfranchised or frustrated. It answers a lot of the questions of why what is going on is going on. And if you go throughout world history and you have significant disparities of one group of another economically, generally that does not go well. It doesn't end well. So these are things that need to be addressed, and they need to be addressed in a thoughtful, sincere, and genuine way, not just to make sure that the wealthy or the well-to-do or well-connected continue to benefit even further. There needs to be some more. Look, I'm not a socialist or communist, don't get me wrong, but there does need to be opportunity for those who have not had the ability to participate in the economic booms that we've seen. See, people have to have hope. And when they lose hope, bad things happen. And when you have large swaths of the population that are losing hope of a better future, that is not good for the future. You don't believe what I'm saying, you should listen to the banks. For example, Capital One, in terms of the economy not being as great as the numbers or the media or the politicians try to tell us, the current administration in particular. Well, Capital One's profit just fell 61% in the second quarter because it set aside more money to cover losses on loans. In fact, banks are now bracing for consumers to stop paying on their credit cards. JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo have now all raised their provisions for credit card losses from the previous quarter. And these provisions are the money that they set aside to cover any potential losses from credit risk, including delinquent or bad debt, and of course, commercial real estate loans they're very concerned about. So credit card debt is at all-time records, over $1 trillion. Delinquency rates are on the rise. Approximately 40% of Americans are concerned about paying the basic bills, living expenses. We're talking food, clothing, housing. And a quarter of Americans are actually skipping meals because they can't afford the grocery store bills. This is an economic recipe for disaster that needs to be addressed. This type of economy cannot continue for an extended period of time, because we will literally move into political and social unrest. And I'm not saying that to scare people. I'm just stating facts from history. You can't have, like I stated earlier, a large swath of people frustrated, disenfranchised, no hope for a better future, and expect them just to take it and continue to take it. Now, there's a lot of things that have gone on to contribute to this. a lot of things politically, Federal Reserve policies. Inflation is a killer, as we stated on the show multiple times, and it definitely hurts the lower income earners more as they have to pay more for things. And a lot of the inflation, of course, is coming from excess government spending. One of the best solutions is the government needs to stop spending more than it receives, or it will literally collapse upon itself, the whole system. A lot of people are concerned about the economic consequences, and those are absolutely real. We'll discuss more of this in the next segment. As the debt continues to increase, the amount of interest payments the federal government has to pay becomes astronomical. And folks, it's already much higher than you realize. But the political and social consequences of this overspending are even dire. Now, it's not too late. We need to change direction. We're barreling towards a financial cliff, a societal cliff, a social cliff, a political one. It's not too late. We have to steer away from that cliff, not continuing to accelerate towards it. So, as I've stated many, many times, one of my number one issues has and always been for a long time, but it's now becoming imperative, is any politician who I believe will spend more than they receive or supports that or has done so in the past needs to be replaced or removed, elected out of office. We have to change direction. You see, the politicians aren't going to do it, folks. Only the people will. It's up to us, we the people, educate ourselves, educate those that are not paying attention, and help them understand how important it is that government spending, excess government spending, and that is frankly anything that they spend over and above what they receive, is the primary cause of this economic dilemma that is facing about 40% of Americans at this point, and will continue to get worse if this continues further, which again spells nothing but doom and disaster economically, socially, politically. This is serious, folks. And don't want you to take it lightly. I don't want to scare anybody either, but I want you to understand how serious this is, the direction we're heading, and we have to change direction. We're headed towards the iceberg. It's like the Titanic. We can see the iceberg on the horizon. Are we going to steer the ship? Are we going to turn and reduce federal spending, get people in office that will reduce the spending or not? That's the solution, folks. Stay tuned in the next segment. I got some more things that I think you'll find eye-opening, particularly when it comes to how much our government is actually spending, the interest on the debt.
Stay tuned for more common sense from Ferens. For more information, contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferens Toth. Want more information? Contact Ferens at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferens Toth.
Welcome back to the Your Personal Bank Show. This is Ferens. I know I was discussing some things in the first segment that maybe are a little eye-opening for folks, but I think it needs to be stated and you need to understand that the economy it's a bifurcated economy. Those who own real estate and stocks have increased their wealth tremendously in the past decade. Those that do not have not, and it's creating a bigger and bigger issue and frustration in the population. And these are not good things, not good economically, frankly, societally, politically, or any of that. But here's some other issues that need to be addressed. First of all, we all know the federal government debt is out of control. It's approaching $35 trillion as we speak. In fact, the debt has now increased by 50% since January of 2020. So in 4 years, the debt has increased by 50% more. The average interest on the debt is now about 5% because of the higher interest rates due to the Federal Reserve increasing rates, which of course they needed to do. The economy was getting almost free money. Low monetary policy was causing a serious bubble in the stock and real estate markets. We've seen that. There's no question. But these higher interest rates are now causing another problem for the federal government, which is the higher interest payments on the debt. So not only, it's a double whammy. Not only does the federal government increase their debt by 50% over the last 4 years, but the interest rates on that have gone up more than double. Therefore, it turns out that it is now stated this year that the interest payments on the debt, just the interest payments, will be over $1.1 trillion for 2024. That's what's estimated at this point. Now, why is that such a big deal? Well, it turns out that amounts to about 76% of all personal income taxes collected by the federal government. And personal income taxes are the largest source of revenue for the government. They collect business taxes and tariffs and other things also, but their number one revenue source, personal income tax, is now getting nearly eaten up, 3/4 of it, eaten up by interest only on the debt. Now, folks, this is unsustainable. There's no two ways about it. You cannot have your biggest revenue generator be eaten up, or for the most part, be eaten up by just interest on debt. If you take your own personal household financial situation, you understand this immediately. No household or business can survive like this for any length of time. The federal government has an advantage of that it can continue to print money to offset the difference. The problem with that is that may be good for the federal government, but that additional printing of money is terrible for individuals. Anyone who lives in this country, it creates more inflation. Again, more dollars chasing goods and services increases the cost of those dollars. And the number one source of that has been the federal government, particularly in the last several years. Certainly in the last several decades, but in the last few years, even more so. So what's good for the government turns out to be bad for the people. And the people need to understand this. This is the education part and how we have to vote accordingly. Again, it comes down to this. It's quite simple. Any representative that supports spending more than they receive needs to be replaced. That is the solution. That's the constitutionally designated solution to this problem. And we don't have to educate everyone. I know when I share this, some people get frustrated. They're like, well, some people will never change. Not everyone has to be educated. Not everyone has to change their thinking or their political beliefs. Only 51% do. We only need a majority. So that hopefully becomes a little more encouraging. And the reason I say that is there's no question that in most parts of this country, and particularly nationally, we're a very divided country. Most presidential elections, for example, for the last number of decades have been nearly 50-50 propositions. In other words, the winner is only won by a few percentage points, 2 or 3 at the most. Well, if you think about that, that's 2 or 3 people. If 2 or 3 people out of 100 change their thinking or educate themselves and realize that government is the problem, not the solution. Government is one causing all this inflation. Government's the one that's causing nearly 40% of Americans to be concerned about paying their bills, and a quarter of Americans skipping meals now because they can't afford the grocery store because they're spending too much money, folks. That's, in my opinion, almost criminal. Representatives are supposed to represent the people. They send money overseas or these other places or for their pet projects or whatever it may be, yet people are literally skipping meals. And you understand why I have the frustration I have, because it shouldn't be that way. And we need to wake up and realize that. Secondly, we have an opportunity to change that, and we can do so in November, start to make a big change in the right direction as far as fiscal sanity. Anyone who's an investor, a homeowner, a household, has a business, if you have a household budget, you understand this. So to support anything outside of fiscal sanity for our federal government is a form of insanity. You should expect and demand the same level of fiscal sanity from our federal government, state governments, city, local, county, you name it, as you're required to do with your household or your business. It should be no different. In fact, in some ways, it's even more important. These are the things that people need to understand. I'm stressing this because we are getting to the point of no return. In 4 years, we have had a 50% increase in the amount of federal debt. The cost of that debt has also increased dramatically because of the higher interest rates. What would another 4 years, let's assume the spending increased another 50% from where it is today? Where do you think we would be 4 years from now? Things are getting bad for a lot of people already. Others are doing fine. But think forward 4 years. What would additional spending over the next 4 years, say another 50% increase in debt, what would that do to our economy? What would that do to the average American? By the way, it'd be a lot more than 40% of people worrying about paying their bills. It might go up to 70 or 80%. My point is simple. We have to think. We have to educate ourselves. We have to understand the impacts of our vote and who we support and how we do this. What kind of economy do we want to have? What kind of society do we want to live in? All these are things that are vastly important to understand. And it's not a popularity contest. It's so ridiculous. It's beyond the pale that people vote for a politician because they like them or what they look like or whatever. No, what are their policies? Are they going to be beneficial to Americans and to people or not? That's what should be done. And right now, excess spending is becoming a critical issue, a critical problem that will lead to economic, societal, and political damage that we may have never seen in this country. We see it in other countries, and some people get complacent thinking, oh, it will never happen here. No, it can happen here, folks. That's naive to think it could not happen here. Economic realities cannot be dismissed or ignored too long. To add insult to injury, not only is our federal government spending far too much creating inflation that's continuous inflation, cumulative over multiple years is what's hurting people. But as they accounted for or pointed out recently, the Pentagon accidentally, quote unquote, paid Zelensky an extra $6.2 billion, and they called it an accounting error. And then later, a week or so later, updated it to $8.2 billion. So in other words, not only are our federal government spending more than they receive, much of it going to places that don't benefit American citizens, which it should, but they're being wasteful about it on top of it. That is insult to injury, folks. That's rubbing salt in the wound. Anyone involved with this should be fired. They should be terminated. They should resign in disgrace. And if they won't, we need to replace them, don't we? And some of this is, government bureaucrats and all that. Well, one, we have way too many of those, but who puts them in charge? The elected officials, the parties we put in are the ones that bring these people to bear and give them jobs and build the bureaucracy. Bureaucrats are just the elected officials' policy. So it's not just what the elected politician is going to do, the elected official, but who is going to be on their staff? Who are they going to who's going to be part of the bureaucracy, and what are they going to do? Are they going to be wasteful and waste $8.2 billion and send it to Ukraine and say, oops, it was an accounting error? Or are they going to do something about it to reduce the wasteful excess spending and start to bring our inflation numbers down? We need them to see them go down, not up. And they're continuing to go up. Yes, they're going up slower than they were, but that still hurts people. It needs to stop. These are all points I'm bringing up because I think it's super important for folks to understand, and you just don't hear about this stuff in the legacy media. They have an agenda, most of them. I'm blessed. I don't have anybody saying what to say or what not to say, and I'm thankful for that. But understand, most of the talking heads on TV or the radio or wherever you listen, or newspaper. They're getting paid by likely someone in one of the oligarchs, probably a billionaire, who is pushing their agenda. If they're sharing what that person wants, and if they don't, they're going to lose their job. So they're much more than a talking head. There's little or no thinking that goes involved with that. So if you're getting your information from those sources, you have to consider the source and think underneath, why are they saying what they're saying? And realize, is this advice or information that I should be really paying attention to or not? Again, I'm thankful and blessed. No one's telling me what to say or not to say. I'm just trying to share from my heart what I see, what I'm experiencing from my experiences, what I'm seeing on a daily basis with everyday Americans that I'm speaking to, literally coast to coast. One of the things I share with people when I first meet with them, and we discuss their financial situation and looking at their goals and their wanting to accomplish and all that, one of the questions I'll often ask is, do you want me to tell you what you want to hear or what you need to hear? And many will laugh nervously and say, I was afraid of that, but tell me what I need to hear. That's the beginning, folks, of navigating challenging, uncertain economic times. Yes, again, or bifurcated. It's been great for some people, not so great for others. And I've got some articles I'm going to discuss talking about where, yes, the stock and real estate markets have been tremendous in the past decade. Record setting, no question, no argument whatsoever. Is it likely that's going to happen in the future, in the next decade? Stay tuned, find out.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference, and if you do want to reach me, you can do so at yourpersonalbank.com. And yes, you will reach me. In fact, I had a listener call me last week just to find out, wow, you did actually answer your phone. Now, I can't guarantee I'll answer it every time you call. Leave me a message. I'll be happy to get back with you. But she was surprised I actually answered. And yes, you will reach me. Again, it's yourpersonalbank.com or toll free 866-268-4422. So it turns out the S&P 500 has just had its worst July in 10 years. Now, what does history tell us about that? You see, historically, July has been one of the strongest months for the U.S. stock market. But of course, July of 2024 has not been. In fact, it's been the worst since 2014, the last decade. Also in the past decade, the S&P 500 has typically traded sideways in August and declined in September. This is all according to Motley Fool. There's a number of Wall Street analysts that are now predicting stock markets to fall more than 15% before the end of the year, and others say it will go up. The other issue we have is the bond market is still sounding an alarm that may signal a stock market crash, and that is the Treasury yield curve being inverted. In fact, it's been inverted for 21 months now, and this particular leading economic indicator has predicted every recession accurately since 1969. It's been sounding the alarm, like I said, for 21 months, which happens to be the longest on record. Previously, every other time that the yield inversion curve, the bond yield inversion curve, signaled a recession, it usually happened between 1 and 2 years. Again, what makes this time rather unique, or definitely unique, is the yield inversion curve has sounded the alarm for 21 months consistently and has not changed. Yet we have not fallen into a full-blown recession yet. And what the yield inversion curve, for those of you that don't know, is that the 10-year note, Treasury note, has been lower than most of the shorter term counterparts, like the 2-year, the 3-month, the other ones. And not only has it been accurate every time since 1969, it's been accurate every time except once going back to the 1950s. And why it's so significant is longer term treasuries typically pay a higher yield or higher interest rate than shorter term treasuries. It's much like CDs, and most people understand this. If you buy a longer term CD, the bank will pay you a higher interest rate because you're locking up or committing your money for a longer period of time. So there's more risk for you, the investor. Therefore, they offset that risk by offering a higher interest rate. And bonds work typically the same way. Longer terms typically pay higher interest rates. Shorter terms pay shorter interest rates, much like CDs. Except it's not been the case for the last 21 months, which is called a yield inversion, which is unusual and typically, historically, is a very accurate predictor of future recessions. I'm starting to see more and more articles wondering if a recession is going to actually occur this time because it's been signaling this inversion for so long, 21 months, again, longest on record. And then I saw one other article here discussing that the U.S. economy may be on the verge of an extremely rare achievement, and that is having a number of these leading economic indicators, like the yield inversion curve, the bond yield inversion curve, signaling a recession, yet not actually really having one. I'm not so sure if that's going to happen. The reality is no one knows if that is actually going to happen, but the indicators point to it. Definitely, they're stating it's going to happen. I think what we're dealing with here is something rather unusual and even historic. The thing that I think is throwing the indicators off, I've discussed this many times. This is a personal opinion, but I've had many confirmations of this to make my opinion even more solid over time, and it's this. The unprecedented amount of fiscal spending and COVID relief money that went into the economy has kind of jacked everything up. It's screwed up the numbers. It's screwed up the norm, if you know what I'm trying to say. The federal government's never done anything like that before, where they injected trillions of dollars literally into the economy. My opinion is this. I don't believe the indicators are wrong. What I believe is they're delayed. They're delayed because consumer spending is about 2/3 of GDP, gross domestic product. And it was consumer spending that stayed strong for the last couple of years, 2-3 years, because of all the excess money in the system. I use an analogy all the time of a business owner I know who had a number of employees. He wanted to keep his business open through COVID. He qualified for the PPP funds. His business actually increased through COVID. He was fortunate that way. But as he stated later, he got over $300,000 of funds. And the dirty little secret was the federal government paid most of his payroll for the year, which was his largest expense for his business. So he had a windfall. And of course, he used some of that money to expand his business and to remodel his home, buy a new vehicle. But if you take that example, multiply that times millions of businesses and millions of people, that's why you had so much economic consumer spending, which juices the economy and throws off the numbers, I guess is what I'm trying to say. So I believe the jury's still out in terms of will we see a recession or not. Here's the concern I have. Here's my fear. Because of the historic amount of money that was juiced into the system, now that it's pretty much gone and we're starting to see things backing off, we may see a historic recession also. Because again, everything's been thrown off. What was the norms have been thrown off. And that's the thing that no one really knows. And I think to ignore that would be foolish to do so. In other words, ignore at your own peril. Things are not normal. The economy is not normal. Yes, there are some people that have done great. As I stated earlier segments of the show, folks that own real estate, owned a lot of stocks and such, they did phenomenal, but majority of the Americans did not, and they have not done so well. And we have a very bifurcated economy, which again is very unusual historically. A lot of things have happened that are just out of the norm. And so the normal readings, the normal leading economic indicators that have been accurate for 50 and 60 and 70 years even have been thrown off. I don't think they're completely dead. I don't think they're should be ignored. I just think they've been delayed or thrown off, which gives me even greater cause for concern because of what may happen going forward. Hey, we may have a soft landing and things turn out to be great. This one article stated it would be exceedingly unusual. It would be historic, actually, if the Fed managed to accomplish a soft landing and we did not go into recession. But again, that's against the norm. If you're an investor and you're betting, you look at calculated risk. I'm an entrepreneur. Entrepreneurs look at we all take risk. Investors take risk, but it's calculated. And you don't want to ignore things that are out there that could be a real problem that are historic. So what am I trying to get at? What are some solutions? I stated this hundreds of times on this show. There is uncertainty, historic anomalies that have gone on that'll likely continue as a result of the historic COVID relief funds, for example, that were injected into the system. Stuff that we've never seen before. Protecting some of your money, reducing your risk. These are all things that would just be prudent. Your personal bank will do that. I've stated this a number of times on this show. This is the best time in 40 plus years for annuities. Annuities have an advantage of growing safely. You can get double-digit returns in good market years with no downside risk in bad years. Yes, they have limited liquidity, but if you're trying to grow your money for the long term, that shouldn't matter. I'm not saying put all your money in something like that, your personal bank or annuities or whatever, but to diversify a portion of your portfolio just makes prudent sense. And I'll give you this last article, this last thought. This is according to MarketWatch. Their prediction is that stocks will not beat inflation over the next decade. The reason they're saying that is it's a valuation model. It's based on a ratio of the S&P 500 to the M2 money supply. The M2 money supply is the total supply of money that is in the United States. This is calculated by the Federal Reserve. The S&P 500 and M2 ratio, which is the total ratio of the money supply, currently stands at 0.25, which is the extreme low end or bearish extreme of the historical range. This is the lowest levels it's been since 1970. The point, this valuation model of the ratio of the S&P 500 to the M2 money supply, it's a predictor of what the stock market returns are going to be over the next decade versus inflation. The point they're making here is that it's highly unlikely the stocks will increase at a rate above inflation for the next decade. This is a significant change of what stocks did over the past decade, where we had easy monetary policy, low interest rate environment, and stocks and real estate increased at record levels. I've often stated what thrives in low interest rate environment tends to struggle in higher interest rate environment and vice versa. If you haven't shifted or adjusted to this reality, it's time to do so, folks. Your personal bank and annuities will both benefit from higher interest rate environments. That's when they thrive. They also provide guarantees and safety to the downside if we do indeed end up in some type of recession or significant downturn. So again, I'm going to encourage you to contact me at yourpersonalbank.com for more information to help you understand how to thrive in the next decade, enjoy likely increasing returns because of higher interest rates. It could possibly be higher returns than you receive in your stock portfolios, for example. Certainly according to this valuation model of the S&P 500 M2 money supply, that's what it's predicting. And also be able to protect the downside on a portion of your portfolio or the monies that are involved with your personal bank or annuities for that matter. So again, I encourage you to contact me at yourpersonalbank.com for more information. I can share with you how to thrive likely in the next decade, rather than just get by. Stay tuned in the last segment. I got a few more things to share I think you'll find very informative, so I'm encouraging you not to miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. I've got a few other loose ends I need to share with you. I think economically you'll find very interesting. And I hope the information I've been sharing the previous segments of this show, I'm not trying to discourage anyone, but I'm hoping that this is very informative and give you more facts so you can make better financial decisions to improve your financial situation going forward. I think the bottom line is what I'm trying to say is what worked before, low interest rate environment, easy monetary policy, is highly unlikely to thrive in the future decade of a higher interest rate, stricter monetary policy, most likely. And you need to shift accordingly, adjust accordingly. That's all. There will be winners and losers. There always are. The people that won the last decade, if they do the same thing, likely will lose in the next decade, or certainly not win or do as well as those that adjust to the economic realities of what's going on with the higher interest rate environment and all that. There's some other things that have happened. One thing, interesting news, the IRS has been waffling for the last couple of years on rules regarding inherited IRAs. Well, they finally have come down with final rulings. I don't think they're necessarily all that great, honestly, but at least they've clarified what's going on. There's been a lot of controversy of folks who inherit IRAs, when they have to take withdrawals, that type of thing, and it's been clarified. And instead of me spending a lot of time going into detail on this show about all the different rules that go into play and what the exemptions are to the rules, I recommend you contact me, yourpersonalbank.com, if you have questions about inherited IRAs. But in general, most people have to take the money out in 10 years. In general, most of them, they want them to take them out over a portion every year. There are exceptions to those rules. And if you haven't done so far, they've waived the penalties in the previous couple of years. So that's good news. But again, if you want more detailed information on it, contact me at yourpersonalbank.com. The good news is they've clarified it, so at least we know what the rules are, and then we can make the best solutions for you. The other thing I want to discuss is real estate. We discuss a lot of real estate because I have so many real estate investors that work with Your Personal Bank and such. And so it's an area of interest of a lot of people. But real estate, of course, has been on a tear the last several years. Things really seem to be changing. I believe we've kind of hit the crest of the wave, if you will. We'll see. But certainly, according to Redfin, home buyers are now backing out of deals at a record pace. This is the highest pace of homeowners backing out of deals in any June on record. Something like 15% of all home deals have not gone through because buyers are concerned, because even though sellers are starting to cut prices, that doesn't seem to be enough, as they point out. They're concerned about interest rates, the overall price of the properties, and where the values of the properties are going to be in the future, because it at least seems like, we'll see, that we're hitting the top of the hill or the crest of the hill. And it could certainly, in certain areas, certain markets, of course, particularly down south, Florida, Texas, places like that, we are starting to see reductions in prices. And here's another reason for concern. Home builders have over 102,000 completed and unsold homes for sale on the market, which happens to be the highest number since 2009. This is according to ReVenture. And this comes at a time when, of course, mortgage interest is high and demand is at the lowest level in 30 years. And there's another, apparently, 275,000 new homes under construction. Now, of course, different regions, this varies widely. It's predominantly in the South and the Southeast. But it seems like right now a record of 1 out of 3 homes for sale right now is a new construction home. So inventory is up in certain markets for sure. Prices are at all-time highs or near all-time highs, certainly starting to weaken. Interest rates are still high. The Fed may give us an interest rate cut or two. A lot of people are thinking possibly even before the end of this year. So they're going to wait and see what happens. And I can't say I really blame them, because what are the odds of real estate really going up a whole lot more from here? Some people think so. And in certain markets, certainly it will. But areas where there's higher inventory, that's probably highly unlikely. So it might, if you don't have to buy right now, particularly if you're in the South, it might be a good time to wait and see what happens. And of course, commercial real estate, oh my gosh, it's just headed to a crisis that we have never seen. It turns out that U.S. banks are facing a real reckoning, because over the next 2 years, over $1 trillion in commercial real estate loans will be coming due. You see, commercial real estate loans do not typically operate like residential. Residential often is 15 or 30-year fixed mortgages. That's the most common. Well, residential real estate loans are typically far shorter, like 3 years, maybe 5 years, things like that. And then the rate on the loan will adjust. So it's more of a variable rate loan. Well, when these loans come due, or when they renew, let's say, at the new interest rate, of course, interest rates are quite elevated from where they were just a couple of years ago. Property values are struggling. A lot of commercial real estate owners are going to be underwater. They're going to be in trouble, and it's like this tidal wave that we see coming. I'm not sure how to avoid this one. I'm not sure what's going to happen, and this is going to definitely affect small and medium-sized banks, because that's where a big portion of many of their loans are. That's where they specialize, commercial lending, is many of the small and medium-sized banks. So this is not only going to cause a problem in the commercial real estate market in a big, big way, but it's a crisis, folks. We're full-blown crisis mode now. But it's also going to translate into many of the banks. An increasing number of banks, again, regional, community banks, such like that, are going to be in very big trouble. They're going to have, and I predict we're probably going to see some serious bank failures, a number of them, in the next couple of years, because they're just not going to be able to handle it unless something dramatic changes. I just don't see any other way around it. And as those listen to the show, I was chairman of the board of a commercial bank or community bank in formation, in fact, and I'm thankful that for mostly reasons of time commitment, I stepped away from that a couple of years ago, before all of this came to light, before interest rates started climbing and creating a huge crisis for commercial real estate, commercial lenders. Folks, it's going to get ugly in the commercial real estate area. Is it going to affect residential? I'd say it's hard to believe it won't affect it at all. I don't think it'll have a direct impact, but I believe it will have at least some residual impact, if nothing else in the mood, you know what I'm saying, will impact lenders, buyers, such like that. So I think it'll overall be a negative push downward on real estate values. And again, they're at or all-time highs. Anyone who invests in the stock market or stock markets or real estate markets or crypto or anything knows, when you're at high ends of the range of pricing, it's just that's when your risk is elevated. Certainly, prices can go up from where they're at. Stocks could go up from where they're at. Certain companies will, but the market in general could go up from where it's at. Real estate certainly could do that. But statistically speaking, the risk and the odds are far, far greater to the downside. And we've shared so many different economic indicators and just, you know, anecdotal evidence, personal experience, what's going on, history, you name it. Just about everything is pointing to the downside, folks. And I guess the 800-pound gorilla in the room, as I was sharing a previous segment or two, is the federal government. All this excess spending is continuing to exacerbate inflation. I understand, not at rates we were seeing a couple of years ago, but it's still higher than normal. And as long as they continue to spend more than they receive, and they're doing so significantly, that will continue to pressure inflation, which will put a hurt economically on a lot of people. And it's going to put a hurt on stock prices and real estate prices and things like that. That's the 800-pound gorilla, folks. And until that really gets resolved, we've got economic challenges ahead. I can't see any other way around it. You can ignore economic realities for a while, but eventually they catch up to you. It's like gravity. You can claim gravity doesn't apply to you. You can jump off a bridge even. And for a while, you're fine because you're flying. But eventually, you're going to hit the bottom and you're going to crash. I don't know when it's going to happen. I'm not saying this to scare people. I'm just stating it's an economic reality. If anyone can tell you when, how much, or how long, my opinion is they're trying to sell you something. They're lying because they don't know. No one knows. It's impossible to know. But will we have a correction? Certainly we will. History shows us that. It's just when, how much, and how long are the questions that cannot be answered. All you and I can do is protect ourselves from that risk, protect ourselves from that downside when it does happen. And hey, it's not just about protecting yourself on the downside, but it's very likely in the next decade that these guaranteed, insured, tax-free, even dividends through your personal banks or annuity returns could very likely outperform what much of the stock market's going to do in the next decade. And I'm not just saying this, I'm talking about, as I stated in the earlier segments, this valuation model, the ratio of the S&P 500 to the M2 money supply. This is information coming from the Federal Reserve. And those valuation models are showing that stocks are very unlikely to outperform inflation, which happens, and they happen to be the most bearish or lowest level since 1970. So it's not me just saying this. Economic models, valuations are saying this, and anecdotal evidence is saying this. Experience is telling us this. So it's not that you're going to be giving up if you reduce your risk. Not only be reducing your risk with your personal bank or an annuity or whatever, but you could very likely be increasing your returns over the next decade also. Because again, these are assets that thrive in higher interest rate environments, while the stock market and real estate, things like that, tend to struggle in higher interest rate environments. That's not rocket science. Everyone knows that. And for folks who keep hanging on, hoping for a interest rate cut from the Federal Reserve, there's been a lot of hopium in that area, and we might see a rate cut or two. I'll give you that. But dramatic rate cuts, there's nothing to show that on the horizon that that's a likely scenario. It's next to impossible that we're going to see 3% 30-year fixed mortgages again anytime in the near future. Frankly, I would even say maybe anytime in our lifetime. What I want you to understand, folks, is that was a once-in-a-lifetime experience or situation. Highly unusual, highly unlikely to come back. So yes, interest rates might come back a little bit, but not like where they were, which means your personal bank dividends, annuity interest rates will continue to climb from levels where they were even a couple of years ago, while as this continues and inflation likely continues because the federal government keeps spending too much money, stocks and real estate in general tend to suffer. That's the message I'm trying to share. I can help you. Contact me at yourpersonalbank.com. I'll answer any questions you have, or toll free 866-268-4422. And let me share with you how to thrive in this next decade. It's getting excited, and I believe exciting, and I believe it's going to get even more exciting as time goes forward. The future is bright, and I'm excited, and I'd like to see you be a part of it also. As always, stay tuned to the Your Personal Bank show next week, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.